Thank you, everyone, for joining. As Nick mentioned, I'm Ryan Thie. I'll start off our presentation talking about finding the deal, basically the acquisition process for BAM. And I'd say there's three components to it. There's the where we're looking, there's the who's helping us look, and then there's the what we're looking for. And I'll start with the where we're looking. We are a Midwest-focused firm. We are based here in Carmel, Indiana, suburb of Indianapolis, and our majority of our portfolio is in Indiana. We also have really strong presences in Des Moines, Iowa, Kansas City, Missouri, a market that we have two assets, one of them being in Fund 5, which is open now. We have an asset in Northwest Arkansas, Bentonville, Rogers, Fayetteville. That's a really emerging market, tons of growth down there. And then Pittsburgh, Pennsylvania, we have an asset in our fourth fund there, as well as a joint venture development project that's coming out of the ground, starting to lease up right now. So very Midwest-focused strategy, which segues into the brokers that help us look. And they're specifically helping us in those markets. We have relationships with multifamily investment sales brokers, some of the household names for those of you maybe seen them on for lease and for sale signs in your communities that you live in, CBRE, Colliers, Walker and Dunlop, Cushman & Wakefield, and the like. That have flags or presences in those markets I mentioned. They're helping us find acquisition opportunities. We're not just looking on the deals they're marketing broadly. We're also looking for off-market opportunities. And we like off-market opportunities being it's not broadly marketed. They'll come to us, say, hey, BAM, we've got this owner in Kansas City. There's this deal that fits your buy box. They'd like to do a deal with you directly. And we kind of go from there. And that takes off the table effectively getting into a bidding war with others. And we're able to really get in at a really good basis on that. And further, we get the majority of our deals come to us off market, largely because we have a great reputation in the marketplace. We have just done a great job delivering on closing on time, not retrading sellers, being really good to work with. And that's helped give us access to a lot of good opportunities and a lot of good operators. Even some of our joint venture development partners are all ones that we've transacted with before. They trust how we operate. We trust how they operate. And that's been a great source of deal flow for us, not just looking at what CBRE is bringing out to market, but rather that broker bringing us the deal and us not having to bid against others. But really, we're focusing in and kind of getting into what we've got listed on the screen here. We're looking for Class A assets. These are institutional quality. They're built within the last 10 to 12 years, and they're located in suburban submarkets with A-rated schools where there are good jobs, there's population growth, and also these markets that we're looking in, specifically the submarkets, because real estate is a local and even sometimes hyper-local endeavor. We're really focused on those submarket dynamics, especially with rent growth and occupancy. And then favorable supply dynamics as well. We don't want to get into too oversaturated, overbuilt markets if we can't control it. So that's a big component of our strategy in terms of acquisitions. But yeah, really looking for newly built in the last 10 years, at least 200 units. That's usually an ideal economies of scale. Larger properties, you can generate a lot more cash flow and growth, and also just cast to a wider buyer pool on the exit where we're selling to institutions, pension funds, more sophisticated operators where there's a little bit more liquidity, and we're going to have a little easier time on the exit versus smaller, less shiny assets that the buyer pool may not be as good, or it might be a little tougher to execute on an exit in that sense. But ultimately, we're targeting over a 3 to 7 year hold, at least a 15 IRR or 2x multiple. So that's really kind of what we're looking for, but also specifically, and I think, Nick, there's another part of this slide, target opportunities and situations. So I mentioned specifically the, where we're looking, what kind of product we're looking for, but also it's ultimately, where is the upside? And for us, our upside is in operations. We can grow the value of the property by growing net operating income, which I'll touch on a lot more, kind of the how. But overall, the situations we really look for and tend to target on these acquisition opportunities is where the operators in financial distress. That can mean they've got a loan that's maturing soon and they need to exit the asset. A refinance is not accretive to their strategy. It could be that they are struggling with operations. It could be that they have equity that wants out. So really, an operator in financial distress is a target opportunity. And then also merchant developers, which these are effectively builders of apartments. Their focus is building, not so much operating. They're intent on getting the project out of the ground, leased up, sold, and onto their next development project. And those developers, and we know a lot of good ones and have bought off a lot of great ones, but they are not being as operations focused. There's a lot of upside in being able to grow net operating income, NOI, through optimizing revenue, realizing some concession burn off on lease up, second generation leases where there's a little bit more upside there, and then also expenses. They're very marketing heavy, so that's a great opportunity for us to add value buying a project off a merchant developer that's fresh out of lease up. One example is Hayden Flats, which is on Fund 5, open now in Bloomington, Indiana. We bought that project here recently. It was not too far removed from lease up, but I'll touch on a little bit later, kind of some of the upside we see there. And then lastly, third-party managers. Third-party managers work for a developer or an owner as their property manager. They're not vertically integrated, unlike BAM, where we are vertically integrated. And the biggest trend that we notice with third-party managers is they do not operate as efficiently, because at the end of the day, they are only getting paid on a percentage of the property's income, total operating income, not net operating income. So with that said, they are not as focused on expense optimization. They're not getting a piece of the promote or anything. They're really just trying to clip a fee. So they will do their best, at least at the operating income standpoint, to maximize that fee. But there's not a lot of upside past that for them. So another opportunity for us to add value by just running the asset more efficiently. So I think that covers my piece, and I'll kind of let Jim go a little further into how on these acquisitions we underwrite them and we structure the deals.
Thanks, Ryan. So there's really, we're going to cover 6 areas of underwriting and deal structuring, and I'm going to go through them in order, but in reality, a lot of this stuff is happening kind of simultaneously as we go through the process of getting our arms around a deal. So the first thing is market analysis, and some of that happens at a macro level. And from a macro level, we're looking for diverse, stable bases of employment. We don't want all of the jobs in an area coming from like one employer, for instance, who could theoretically, find themselves in distress or laying off or, dramatically impact the project. The second things that we look for from a macro perspective are rent to income, dynamics that are sensible and in check so that people can actually afford the rent when they come to our communities. We also focus on landlord-friendly markets. So, we sort of stay out of the ones that are overly, favor the renter in case we have some problems with collecting rents or need to get a tenant out. On a micro level, we're looking for demand drivers. So there's the demand side and then obviously the supply side. Everyone talks about supply and demand. The demand drivers would be job creators, new things we see coming into a market that could be good for jobs. So for instance, about 15 miles northwest of Indianapolis, Eli Lilly's investing in the Leap District. And that's a market that we're clearly investing in and one that we're very focused on. Similarly, Hynix, which is a semiconductor company, is about to open a massive plant in West Lafayette. So again, those are good demand drivers for those markets. On the supply side, as Ryan mentioned, we're looking at the construction pipeline. What new projects are either on the drawing board or in process of being built that could be delivered during our hold period, creating, new supply that would put downward pressure on rents. So we need to really understand those. And together, the demand drivers and supply side really give us a better picture of how we need to think about and perhaps forecast rent growth as we underwrite the asset. And then the final piece of a market analysis would be looking at the competitive properties in the market. Is our target asset leasing above those or a little bit below those? If we're top of market, we know that we're probably going to have a little less pricing power as we hold it, and we're going to be relying more on those market dynamics. So moving into the next, part of the underwriting and deal structuring is the underwriting model itself. So this is a financial model. It's generally a discounted cash flow model. We call it DCF. And the goal of the model is to really determine within our investment criteria. And, as Ryan mentioned, we're targeting a minimum of a 15% return. But what can we pay? So basically what it does is it lays out all the cash flows that we expect over the 3 to 5 year hold of the property. As we do the underwriting, it's important for people to understand that we look at hundreds of deals for every one that we might bid on. And even as we bid on those deals, a lot of them we're not awarded the deal in the first order. But sometimes when a buyer that they do select doesn't perform, that deal will come back to us because, again, as Ryan mentioned, our reputation with the brokers is that when we say we're going to do something, we do it. And so they tend to give us a little more weight. And the last few deals, in fact, have gone that route where we bid on them, we're not awarded them, and then they came back to us. And then we negotiating the purchase, there's a little bit of back and forth, but again, that's effectively putting the property under contract, similar to when you would like do that with buying a house after you win the bid. The next is really developing the business plan or forming the investment thesis of the property. And this is really kind of understanding why the property is a good fit for BAM Capital and how we can formulate the specific things that we can do that Ryan will go into about ways that we can add value at the operations level. So, there's numerous factors that kind of go into thinking about the business plan. And really what it does is it helps us formulate an opinion of how long it will take to execute the business plan, the specific steps that are going to be involved in executing that business plan, and all of that sort of determines our hold period. And so that the hold period obviously is important, and I'll get into kind of marrying that up with the debt later. But another thing that we really go through as we underwrite and deal structure is the physical inspection. It's important to walk every unit. We don't want any surprises after we close. We need to know what residents are doing in those units and what the physical condition is. Obviously, we're doing the physical inspection to also understand if there's a lot of deferred maintenance or if we have to budget capital as we look at the overall investment and just to really understand the general condition of the project. But we also don't just tour the property itself. We really look at the surrounding areas. We're looking at access, to the property, visibility of the property, potential noise from either traffic or other, neighbors in the area, problem neighbors. You could have a restaurant that has a distinctive smell if it's like a barbecue place or something like that, or worse. And then we also really contemplate vacant parcels to make sure that somebody's not going to build a competing project, adjacent to us or something along those orders. The next step in the underwriting and deal structuring is contemplating debt. Obviously, cost and debt coverage, from the cash flow of the property are significant considerations, but we're also trying to marry up that debt with our expected hold for the project. If you go back to the investment thesis where we were talking about the idea of really thinking about the business plan and how long it might take to execute that business plan, we want the debt to have some adjacency to that. It needs to be flexible so that if we execute the business plan a little quicker, we can sell a little sooner. But it also needs to be flexible where even if we've executed the business plan and the capital markets are in such a situation where we can't, we don't think it's in the best interest of our investors to sell at that time, maybe we need the flexibility to extend. So all of those are kind of factors as we contemplate the debt. And then the final thing that we really look at is risk management and downside analysis. One thing I could say with confidence is almost everybody who's ever underwritten a deal knows that they're all wrong. 100% of the time, something will go a little bit differently than you planned. And, so we always say, what could possibly go wrong? And, there's no question that we need to have contingency plans. We need to build into our underwriting and our modeling, you know, contingencies, significant and rational reserves, which, we pride ourselves on being very conservative with that. We need to hedge for interest rate exposure. In case interest rates spike, we generally are buying caps to make sure that we're not going to get blindsided with, additional debt costs and things like that. So, and then obviously we don't just think in terms of how much we can make off a property. We're looking at, again, what could go wrong, look at a downside analysis so that even if things don't go perfectly according to plan, we're still going to make a reasonably good return for our investors. All of this is really, with a mind's eye towards, how can we make sure that we're going to do right by our investors and deliver a good investment return for the fund. So I'll turn it over to Ryan to talk about the operations.
Yeah, so as I'm sure we've said ad nauseum at this point, I mean, operations is everything. It's a 3 to 7 year hold typically on these assets, and it's 3 to 7 years of hard work going into operating the property to ultimately achieve our desired outcome for our investors. So with that, we operate with the axiom, BAM management, our property management and asset management arm operates the axiom that for every dollar we can increase NOI, net operating income, be it we're reducing expenses or we're growing revenue, we're basically increasing the value of the asset by $20. That's kind of our approach. So any way we can move the needle on NOI, it's moving the needle on value and focusing on what we can control. So it starts with our in-house management and construction. Mentioned vertical integration earlier. I'm sitting here at our corporate office. Next door to me is Laura, our VP of Property Operations. Next door to her is Ashley, our VP of Property Management. Next door to Ashley is Danny, our VP of Maintenance. And I'm in a meeting with them every week. I talk to them daily. We are very much aligned and integrated on what the strategy is for each of these assets. And it makes us, that alignment and responsiveness is everything, because in a lot of cases where you're using third-party management or everybody's scattered, it can be really challenging. But for us, being integrated is everything. And also BAM companies started as a property management company. We started managing other people's deals, learned through that and grew through that, and moved on to what we do today, which is focus on our assets. We don't do any third-party management. So it's all focused on our portfolio and that in-house management. And then the construction piece, to be clear, is not development or new builds. We're not a general contractor. We're not a developer. But that construction arm is a team of individuals that have been in the multifamily, property management, property maintenance, renovation, heavy, CapEx, painting, things of that nature. They all have experience in that. And they're captive to us, and that they're working on projects that we need, that we can realize some savings. Whereas if we shop that out to a vendor, we'd be paying their overhead, we'd be paying their markup and everything else. Whereas we can control a lot of the pricing on those projects that we have the capacity to be able to do ourselves. That segues into kind of a typical area of expense savings. The biggest controllable expenses we have are general and administrative expenses, all the odds and ends, operating the properties, marketing, which kind of speaks for itself, the cost we spend to advertise the properties and the rental units and leasing and all of that. And then repairs and maintenance, which is the biggest controllable operating expense we have, and utilities being another, largely controllable. Repairs and maintenance is the biggest that we can really influence with our in-house management construction. We have a really robust training program internally that teaches our maintenance supervisors and technicians how to do a lot of these maintenance tasks on these properties that typically a lot of companies will hire out to third-party vendors, such as HVAC, heating, ventilation, cooling, fixing furnaces that go out in the winter, fixing air conditioners that go out in the summer. We can replace units in-house. A typical HVAC replacement these days, full system's about 8 to 10 grand if you're calling out a vendor. But we're doing that for probably about $4,000 in a lot of its materials. So that's a really material savings, not only to the bottom line, but to cash flow and ultimately the value of the property. Then, I mean, they're dealing likewise on appliances, on plumbing work, on electrical. And we even have a specialized team of some individuals that were formerly plumbing and electrical and HVAC contractors that can go to specific sites and support where they're needed in high times where there's a lot going on, or if we're short staffed for whatever reason. So we have a lot of flexibility and capability there, and ultimately it helps drive value. And then economies of scale. We hit on that earlier briefly, but economies of scale being big for us and what we do, where we have a great concentration of properties within a submarket where they can share vendors. Those vendors are going to get more aggressive on pricing and terms, and they're going to prioritize our projects and needs over that of smaller customers. So it really behooves us to strategically acquire properties within close proximity to one another. And we realize a lot of that here in Indianapolis and Des Moines, Iowa, and we're actively working on that in Kansas City, Pittsburgh, Northwest Arkansas, those markets that we've recently entered into. So economies of scale is everything, getting just a little better pricing and a little better terms and better service. And it makes operations a lot smoother and impacts the bottom line. And then next is increasing rents as underwritten. So at the end of the day, when it comes to rents, I don't want to say that we have total control over, because at the end of the day, we're market participants. Supply and demand dictate a good deal of that. That said, we're very strategic, as Jim's talked about, in our underwriting, very conservative, looking very closely at supply and demand influencers, be it especially the construction pipeline, but also looking at overall demand, comparable properties. Where's their occupancy at? Where are their rents at? If we feel like occupancy is really high, supply is limited, and demand is still really strong, that's an indicator that there's probably good chance we can push rents a little bit. Whereas in some cases it might be different, or we might have to pivot, and that's not uncommon. But that leads on to really what we especially can't control, whether supply and demand are high or low, is ancillary income. And what ancillary income is effectively the fees that we collect on top of rent. The biggest being our utility bill backs for master metered water, sewer, trash, and other fees, pet fees. Half of American households have pets, so we experience that the same. That's a great revenue source, and we have a lot of great amenities for pet owners at our properties. And then valet trash is a good example of an ancillary income stream. With these being Class A communities, a lot of these residents desire convenience. So valet trash is effectively where 5 of the 7 nights a week, there's a special trash can that our residents can put their waste for that day in, and the vendor will come by and pick that up and take it to the dumpster for them. And it's really nice convenience for them, but it's also good ancillary income stream for us. We're typically making about $10 a unit per month on that. And also that trash fee also offsets some of our expense for the larger trash compactor dumpsters on site. And then bulk internet, another convenience. Internet is basically like water these days. Like, you got to have it. And rather than residents have to worry about picking a provider to come in, hook everything up, they're paying whatever the rack rate is, they're dealing with all the increases. This has become a very common trend in our industry, in our portfolio, where we as the apartment community owner and operator will contract with a provider, and they'll provide the same internet service to all the apartments, and we'll charge them a flat fee that's usually a little bit less than what the rack rate is if they subscribe directly with the provider. And we're able to get a nice little profit off of that. I'll give an example. We're in the process of implementing that at 4 of our 5 communities in Des Moines, Iowa, that we own and operate. And we're looking at, once that's all ramped up, usually takes up to a year to realize it, but we're looking at about $30 a month per unit in NOI growth, which translate that back to the $1 of NOI growth to $20 of value. That's across those 5 assets, about over $5 million in value creation alone. So really proud of that. But overall, I mean, that, improves the resident experience, and it makes our communities more attractive in this rental environment these days. And with that, I'll hand it over to Jim for the payoff, the really exciting part, the exit, where it all comes together. So take us home, Jim.
Yeah, great.
Thank you.
Hey, I just want to emphasize this too on the point you illustrated it there on the internet, but also I was just thinking about when you're talking about the valet trash, for example, if it's $10, a month per unit on that, right? The every property that we own is around, two somewhere between 200 and 400 units. So, scaling that across all the units on the property, that makes a massive impact to the bottom line. And so I just wanted to call that out. So you can do that, right? Bulk internet, and you talk about valet trash, pet fees, those kinds of things. Those are really big needle movers for the property. And then at the end of the day, for you, the investor, which we'll get to the example now.
Absolutely.
Thanks. We thought it would be really helpful to walk through a super simplified example. And as I walked through this, I wanted to really point out two things that I want you to kind of grasp onto as takeaways. And the first is that first, we do not need to double the value of a property in order to double our investors' money. Um, for some people that's obvious, for others it's not. So keep focused on that as we walk through the numbers. And then the second thing is that the sponsor doesn't earn a promote until all investors get their capital back plus their preferred return, which for Fund 5 is either 7 or 8%, depending on how much you invest. So in our hypothetical example, we're buying $100 million property, Fund 5. If you can go down a couple, yeah. So the first thing we would do is within our underwriting, look at the mortgage, make sure that it's affordable. We have good conservative coverage, and in this case, I've said we're going to get a 62% mortgage or $62 million for a $100 million asset. We would put a little bit of preferred equity on it from the BAM Preferred Credit Fund. And then Fund 5 the balance of it would come from Fund 5 as common equity, which is what we're talking to you today mostly about. So in this case, again, super simplified example, there's no prorations. We don't have a lot of deal costs in there. We're trying to make this simple so that it fits the scope of this discussion. After we've bought the property, as Ryan indicated, we go through, we do all the hard work of managing it. We lean on the property management team, the operations team, the leasing teams, and the maintenance teams to create a great resident experience, add value at the property level, and increase the net operating income so that when we decide it's a good time to sell into the capital markets, we take the project out for sale. By doing that, we basically work with the brokers who bought us the deal in the first place. Generally, we're pretty loyal to the person who brought us a deal on the buy side. We'll often use them for the sale. They'll do a broad marketing. They'll blast it out to 100 potential investors, 200 potential investors, whatever they have in their cadre, probably thousands in reality. And we'll negotiate a sales, we'll select a buyer, they'll go through diligence, and it's time to sell. So then we finally get to the closing table. And in our hypothetical example, we've said that we took our $100 million property, added enough value so that we've negotiated a sale of $145 million sale price. And so at that time, when we close, Nick, if you can kind of keep going, the first thing we pay back is the mortgage, then the preferred equity, and obviously every sale has sale costs, and that generates a deal level proceeds. In a success scenario where the investors have gotten above their preferred return and their capital back, the sponsor will earn a promote, and then that yields up net proceeds that will go to the fund investors. In this case, kind of following through the math, it says 62.7. That 62.7 million includes the investor's original $30 million from Fund 5, which is the second line at the top. And that effectively generates 2.1 multiple on invested capital, which we refer to as MOIC. So in this hypothetical example, we added $45 million worth of value to a property that we bought for 100 million, and we were able to generate a 2.1 time multiple on our investors' equity. So kind of to summarize this, you engage with BAM Capital because we are experts in our local markets. We rigorously search and underwrite deals. Our operations, leasing, and maintenance teams execute at the property level, which is hundreds of people involved in the process. We deal with curveballs in the market or at the property level, and then we pick the right time to exit at all along, focusing on how we can maximize value for our investors. So, Nick, do you want to take a few questions?
Yeah, well
Or did I miss
stated.
it, or did I miss anything?
Well, I appreciate you asking me that. Thanks, Jim. I'm always here to correct the CFO any chance I get. Just kidding. But yeah, excellent overview. I just want to double click on one thing there, just on the net proceeds. Back to the investor on the 2.1 times return. So just to put it into real, so if you were to invest $1 million, just easy example, $1 million back to you, you would receive 2.1 million in this example. So just to put that real example there for investors.
That's right. Yep.
Yep. Excellent. But yeah, and just to illustrate, I just want to illustrate the point there. Like we covered a ton of ground, and the reason we showed that picture at the beginning, uh, I'm gonna, I thought I was gonna pull it back up here, but that picture with all those people in it, they helped to execute and to operate this. And as Ryan and Jim talked about, when it comes to operating the property, the team on site, that's our team as well. The team here in the office that works with that team to make sure that we're executing the business plan day in and day out, making adjustments and pivots as we need to respond to the market, to things happening at the property. That's all here on our team. Having a pulse on the ground in person is super important. So just wanted to stress that one more time. So thanks everybody. Thanks Jim and Ryan for walking through that. We've got time. We've got time for questions as we wanted to and hoped and promised. I see one in the chat already. That's a great kind of financial modeling back question. But before we jump to that question, anybody have any questions also just kind of related to some of the operations, some of the slides that we had here? And you feel free to raise your hand, come off mute, and you can ask Jim or Ryan directly. It's always the first. So who's going to be the brave first one?
Hey, Nick, why don't we address the question that's in the chat, which, has to do with respect to modeling. When you look at the actual results produced by our portfolio during the COVID years, how deviant were the actual returns from the modeled and forecasted adverse cases? So I, I, let me address this. I think anytime there's a shock to the system, whether it's, the GFC of 2008 or an incredibly unimaginable curveball like COVID, there's a variety of outcomes, and there's no question that people were surprised by COVID. What I can tell you is that resident retention and resident mobility was better than most people expected. I think people just didn't know what to expect, and they tended not to do a lot of apartment moving and hopping. We certainly didn't see our results improve. The government, was forced to cut interest rates, which actually turned into kind of a good thing. But whenever there's a shock to the system like that, it really comes down to how resilient is the capital stack for either the fund or that particular investment. And again, one of the things I tried to highlight and stress is that we really are focused on having reserves well in excess of just what the lenders mandate, and really more about looking at what it takes to kind of weather a storm when we establish those reserves. And so what I can tell you is nobody wanted to sell during COVID, certainly including us. And so I think what we can tell you is that if you're not selling, then you haven't really baked in what might have been a bad return if you did sell at that time. And so I think, I don't think we were overly hurt by COVID. I mean, Ryan, do you have other anecdotal um, thoughts on that?
I think that's a great way to put it. I think I'd add to that that during COVID was actually a really good vintage of investment for us, and there was a lot of uncertainty then. Some of our best buying opportunities were really in that 2020, 2021 era, especially where a couple of those were some operators panic sold, so to speak, at that time, and it was really opportunity. I'd almost feel like we're in kind of a similar situation now with what we're getting into. I mean, who knows how this situation in the Middle East is going to pan out? But I think that at the end of the day, like we really kept our foot on the gas, both from an investment standpoint, but also an operations standpoint, and that
Yeah.
really speaks to the depth and resiliency on the operation side and our roots as a property management company. It was a really challenging time to operate. I mean, we really had to work through it. And especially at that time, we had probably what I would classify as a little bit more of a workforce housing heavy portfolio at that time. It's evolved more to up, where we are today, these class A communities, where we'd see residents a little bit more durable financially in tougher times. But I mean, our folks really had to work all the rental assistance, all of that. I mean, I remember that. We thrived during that time. I think it really taught us a lot, and yeah, I think that was a good era. We learned a lot and grew a lot, and I think we had some great investments during that time.
Right. Somebody asked about the type of leverage and the level of leverage that we use. So generally speaking, we favor floating rate debt compared to fixed rate debt. And the rationale is really the flexibility upon sale. Fixed rate debt is really hard to unwind because you're subject to yield maintenance or defeasance, which just means that it's a little more costly to unwind the debt if you don't sell at or near maturity. Floating rate debt is a lot more flexible. Obviously, we hedge interest rate exposure using debt rate caps in order to make sure that we don't get blindsided by interest rates. So generally speaking, we're in the 60 to 65% leverage range.
Great answer. Thanks for that, Jim.
Yeah.
This kind of goes with that. PK. I don't know if PK is Paul, but PK asks, say there are 4 properties in the fund. So most of our properties, just for everybody on the call, if you're new, most of them have at least 5 assets within them. So example will definitely go across. We don't sell them all the same day or even the same year necessarily, depending on when we acquired them and when the right time to sell is, as Jim talked about earlier. How do we distribute gains to investors after you sell them all, after each asset sale? Shed some light on profit distribution.
Yeah, I
Jim,
mean,
you want?
generally speaking, when we sell an asset, if there's needs within the fund for us to reserve some cash, we might reserve a small amount. But generally speaking, if we're selling a fund asset, we're generally distributing the proceeds from that sale up through to the investors. So we don't sequester it all for the back end of the fund. You know, and you're right, it will happen as we sell the individual assets, not all at once.
Mhm. Yep. And then Thie, maybe you can speak to this a little bit too. Are the properties immediately cash flowing? Does it take some time? What's the process there?
Well, short answer to that is yes. We're looking for strong in place cash flows. We're not looking for something that's not making money day one, so to speak, because at the end of the day, we want to pay our monthly distributions to investors. That said, the growth of cash flow is where the focus is. We want to continue to grow cash flow, grow, NOI, which ultimately leads to cash flow. That's what we're looking to grow. But yes, that's the reason we're focused on these Class A stabilized communities. Their occupancies are in a good spot because the cash flow is in place day one. It's not like whereas a development deal where you get it out of the ground, you got to get it leased up. that first 6 to 12, 18 months of that lease up, you're not really seeing any positive cash flow. But with these existing stabilized assets, we're just focused on growing the cash flow. The cash flow is already there. We're just trying to grow it.
Yeah, great.
Dovetailing on that, Ryan, Fred asked a question about Fund 3 where he's receiving monthly income, but he invested in Fund 5 and there's no monthly income. And one of the things I wanted to mention is that in Funds 2, 3, and 4, we had A shares and B shares. The A shares were were sort of preferred where they get current monthly cash flow, but don't really share in the upside of the ultimate asset as directly. And in Fund 5, we split those A shares out and created the BAM Preferred Credit Fund. So if you go to our example, that $8 million would get a current monthly distribution, in our numerical example, would get a current monthly distribution, whereas Fund 5 and most of the common equity in Funds 1, 2, 3, 4, and 5, the B shares in Funds 2, 3, and 4, or all of Fund 5, they're more event driven towards the end when we sell the assets and less aligned with the property cash flow. It doesn't mean that there couldn't be cash flow distributions to the B shares. We're always, as Ryan mentioned, trying to maximize property level cash flow. But there's probably a fundamental difference between, Fred, how you invested in Fund 3 and the nature of Fund 5 being common equity. So hopefully that answers your question and doesn't confuse the issue.
Yeah. And Fred, I will just say, whoever your point person was, whoever you talked to for your investment process, you can reach out to them too, and we can hop on a call with you too to talk through that as well. Yeah. Great question. Yeah. And I think, I'm glad you laid that out. The current things that we have offerings today is the BAM Preferred Credit Fund, which is an income generating cash flow. So people who are looking for income replacement, a lot of times they're investing in there. They're just wanting the cash flow, not necessarily the upside. And then Fund 5, which will have 6 to 10 properties that will buy and place in there. That's all common equity. And that is participating in the growth and the upside of that, which was really the example that Jim laid out in terms of the 2.1. So we can hop on a call with myself, somebody from my team as well, and we can walk through all that stuff in more detail with you.
Yeah. So Chris asked a question, and he said that most of the investments have a guaranteed return. How is that calculated in the overall deal numbers? Chris, I wish we could guarantee returns. We can't. We have a preferred return, and the preferred return really outlines the fact that the sponsor will not profit related to the promote until you've returned your capital plus that preferred return of either 7 or 8% in Fund 5. So, again, we do our best to. So far, we've never lost a dollar of investor money, but we don't really have guaranteed returns per se. We have a preferred return at each deal level.
Yeah, good. David asks, what specific, this is an underwriting question, so either one of you could take it, over the next 24 to 36 months, and are there geographies or submarkets that we're intentionally avoiding right now, and why? It's a great question.
I mean, Ryan, either one of us can handle this, but I would say,
Yeah, I guess breaking it up, biggest thing we're focused on the next 24 to 36 months, I think, is just what we can control. I think, with rent growth, as I mentioned, like we're market participants. So really we do hone in on that supply and demand, that construction pipeline, and really looking at the fundamentals within the market and within these submarkets and where are they trending. If we feel like there's concern for trend, we're maybe pausing on those, or if there are opportunities that come our way, we're even more conservatively underwriting those than we can. I would say really our focus right now, I don't think it's as much avoidance, but it's more focus, is focus on the Midwest, focus on these markets where we have an existing presence, and especially those sub markets where we feel really good about the pipeline. I think that's more what it is. It's not we're looking everywhere, but we're picking our spots. I think it's really more focus for us, specifically in these markets within Indiana where we have a good presence. Bloomington being one of them. I mentioned Hayden Flats. We really like those kinds of markets where there's solid growth. There's a limited pipeline, and then Kansas City being another, where we've got Kinsley Force that we recently acquired in Fund 5. Kansas City has really performed well fundamentally over the years. It's a lot like Indianapolis, our hometown, and we're trying to further scale in that market, especially in sub-markets where there's limited supply and still really strong demand, good jobs, great schools, places people want to live. So I think that's more our focus is, all right, what spot should we really like? It's really, where are we now? How can we continue to get better? Where can we find good opportunities? I think it's more focused than anything.
Yeah. Yeah. I think there's no question it's a really important time to be cautious, but I also think that as we've seen a little volatility, uncertainty related to tariffs, which turned out largely not to be as bad as feared, uncertainty related to the Middle East, you know, we are seeing some pretty interesting buying opportunities. So if you are focused on those micro markets and really careful about thinking about supply and demand fundamentals in those micro markets, we think that the next 24 to 36 months are going to become really good vintage years for the buy side of our business. Um, yeah.
Yeah, great. There's a couple questions that are related to single assets we'll get to, but then there's one on when is Fund 5 closing, and then what's expected bonus depreciation on the average property. So Fund 5 closing as soon as we can raise all the capital and acquire all the assets, for it. But I don't know the exact timeline of when it will close. So it's a good question, but could be a year, could be less, could be a little more. We'll see just how investors' appetite is, and also to Jim's point about acquiring assets, we've got to find the right deals to acquire and to add into the fund, and that's super important, right? If you go back to the first slide that we walked through with Ryan, what are the things that we look for when it comes to buying a property? We're disciplined and strict around that, and we'll stick to that. Just because we have the capital doesn't mean we'll go and buy something. We want to got to match it up to the timing, the right asset with the investors, and making sure that we can deliver on the results that we're sharing and saying with you as we partner up together. So there's that one. And then Ryan, on expected bonus depreciation on the average property, or maybe Jim, you want to take that? Right, we're in the 100% bonus depreciation years. What's kind of average? What do we anticipate and expect?
Yeah, I mean it's a property by property analysis. We do engineering cost segregation studies on the assets and try and determine how much of the asset could be classified as the shorter lived assets that really can benefit from that 100% depreciation in the recent tax legislation. But by and large, we're seeing things are probably going to be around the 75 to 80% range, based on capital invested. It was a little bit higher in 2025, but it probably will be a little bit lower in 2026, if I had to guess.
Yeah,
So,
great. Thank you.
yeah.
Ryan, thank you, sir, and for putting that back in there about Crossing 5. He asked about Crossing 5 compared to the model, just in terms of building. So for those who aren't aware, we've partnered with some developers, and we have a few single asset development new builds that we partnered with, and Crossing 5 is one of those here in an Indianapolis submarket. So Ryan, can you answer that question real quick?
Yeah, I can give a brief update. Construction's on track and on budget. They're starting to take delivery on some buildings, starting the lease up process. It's just really early on in that to give a material update from there. But to date, construction's on track and on budget. And We'll have a more robust update in our quarterly reports for those investors in Crossing 5, as well as our other investment vehicles, funds, and other single asset ventures here in mid-May for Q1, as of the end of Q1.
Perfect. And then rolling into, John asked a question around single assets that we've had in the past, right? Versus fund assets. He goes, do you typically see a difference in returns with a single asset investment compared to bundled ones?
Short answer is no. It really is contingent upon the hold period and the strategy. Uh, so I don't think I mean, Jim, you can add to it, but I don't think there's a super big
No, I
distinction
think,
between whether it's in a fund or a single asset. It really has a lot to do with hold period and cash flow and other factors.
well, and the individual asset dynamics. So,
Yeah.
I think single asset, you're just subject to, you don't have the diversifying benefit of a fund. So that's just one of the differences. Um, but yeah, I don't see a material difference between that. Somebody asked about our track record and properties that we've held for 3, 4, 5, 6 years. What I can tell you is we have an incredibly strong track record. We've sold how many, Ryan? 15, 16
Pushing
properties?
15. Yeah.
Yeah,
Yeah,
yeah.
15.
14 with one under contract, I think.
Yeah.
But our track record is a net IRR in net to investors, in the mid 30%. And in terms of properties that we've held 3, 4, 5, 6, 7 years, with kind of looking at everything, what I can tell you is that the last few years it has to sell. So some of our holds are stretching out a little bit longer. But by and large, we're continuing to execute the business plans on the assets that we hold. And then the last part of that question is opportunity zones. Generally speaking, we don't invest in opportunity zones. As I mentioned, we focus on top school districts. Opportunity zones are usually economically disadvantaged areas. There's special requirements to take advantage of the opportunity zone investment rules that really don't fit with our fund model. And so for those reasons, we don't generally focus on opportunity zones. We haven't done any to date. So,
Great.
yeah.
We'll take one more question, and we're coming up on our time, and then we can talk more about if you have further questions. So last one that's posted in here, I think we've gotten to all of them, is taxes on income and long-term gains.
Yeah. So a couple people touched on taxes, and what we can tell you is that generally speaking, our properties will generate long-term capital gains, which are taxed at better rates than ordinary income. Um, Depending on your tax situation, you may be able to take advantage of the tax losses to offset other sources of tax. Let me rephrase that. Of tax losses you could use to offset. But again, these are considered by most people to be tax efficient investment vehicles and really good for people to manage their overall tax burden related to their investments. So, and it varies. It's hard to be specific because it varies a lot on your individual situation. So I would say spend a little time with both your tax advisor, but you can contact the person that you deal with at BAM Capital to discuss how it might affect your personal situation.
I have a question about possibility of 1031s or Delaware trusts. Do you guys get involved with that at all?
We do not at present. It's something we've looked into, but what we can tell you is if you're selling an asset and you invest in Fund 5, a lot of the losses generated from, as long as it happens in the same calendar year, a lot of those losses could help reduce your tax burden from that sale. It's not a perfect 1031, but it could be beneficial to you even if it's not a 1031 exchange.
Okay, thank you.
Good question, Mark. Awesome. Thank you, Jim and Ryan, for going through everything, for answering the questions. Thanks everybody for joining us today for the conversation, questions, the insights. We really appreciate that. If you have interest in learning more, right? If you haven't spoken to somebody on our team yet before, so Mark, you and your wife, I didn't catch her name. That's my fault. We'd love to chat more and learn more about your situation. If anybody else is on the call and you haven't talked to somebody here, just shoot us an email at
What's her name?
invest@bamcapital.com.
Karen.
We'll be talking to Catherine Herron. We have an appointment to talk to her in the next few days.
Perfect. That's perfect. Yeah.
So thank you.
Yep. Thanks, guys. But anybody else, feel free to reach out to us. We'd love to talk and chat, understand your situation, what you might be looking for, concerns, opportunities that you might have for us to partner together. So appreciate your time. Great to meet you all. And the last thing before I let y'all go, we love meeting people in person. So if you happen to be in Indiana or coming to Indiana in the next couple of months, we've got an event for you. We've got our annual town hall, which we host here in Carmel, Indiana, suburb of Indianapolis, April 29th. So hopefully you've gotten an invitation for that already. If you haven't, we can send you more information about that, but it's an opportunity to meet our team, smallish group setting, a couple hundred of your best friends in a room, meeting people, mingling, but then hearing from our founder CEO, Ivan Barrett, and our president and CIO, Adam Arrett. They'll be giving updates that day. Then we're doing a day at the track, Indianapolis 500, big deal here. We love it. We're having a day at the track with investors. So please, if you can join us, let us know and come on out. And then we're doing a trivia night with our philanthropy partner, Firefly Children and Family Alliance, Thursday, June 11th. So if you want more information about that or you want to come to one of those, just reach out to us at invest@bamcapital.com, and we'll look forward to meeting you in person, putting faces to names. So thanks, everybody. Great to see you all. Great to meet you. Hope you have a great Friday. Enjoy the weekend. And Mark and your wife, enjoy your cruise, and hope it's safe travels. Take care, everyone.
Thank you all.